The market isn't crashing. It already moved. Welcome back to Richard and Chloe A.I. Investing. Here's the problem most investors are facing right now. They're still positioned for the market they feared, not the market that actually showed up. So let's stop guessing and look at what really happened. Technology didn't move as one group. Semiconductors led, software applications moved. Equipment and infrastructure tied to real demand worked, but consumer electronics stalled. Legacy hardware stalled, comfort tech went nowhere. Communication services told the same story. Advertising worked, entertainment worked, internet platforms with real monetization worked. Telecom didn't. The market wasn't buying categories. It was buying execution. Now look at where people hid. Consumer defensive barely moved as a sector, but underneath, the damage was real. Packaged foods collapsed. Household and personal products bled. Grocery names lagged. Outside of tobacco and a few pricing power winners, defense didn't defend anything. And if you owned it through broad ETFs, you didn't get safety. You got dilution. Now here's where the signal gets loud. Basic materials didn't creep higher. They surged. Gold miners exploded. Copper moved. Industrial metals moved. Not because of fear, but because of leverage and real demand. Industrials confirmed it. Aerospace moved, defense moved, construction moved, electrical equipment and specialty services moved. But railroads, freight, and transport-heavy names were left behind. This isn't random. This is the market rotating from comfort to participation. And this is exactly why we made changes. We trimmed over defensive exposure. We stopped letting yield dictate decisions. We leaned back into growth with earnings, inputs, and leverage to real activity. Because here's the uncomfortable truth. If you're still working, still earning, still adding money, a portfolio built for stability is now a headwind. Volatility didn't hurt portfolios this year. Misalignment did. So here's the takeaway. The market rewarded selectivity, real demand, and execution. It punished comfort, broad exposure, and lazy positioning. That gap is the difference between participating and watching. As we head into the new year, don't ask if your portfolio feels safe. Ask if it's aligned, because the market already made its choice, and playing defense too early is riskier than volatility. In our next episode, we're going to get very specific. We'll walk through what we trimmed, what we kept, and what we added, and how to stress test your own portfolio the same way. If this helped you think differently, hit like, subscribe, and share this with someone who needs to hear it. We'll see you in the next one.